All right, folks, it is September 10th, 2024, and we have the absolute pleasure here of welcoming back Marcel Kalinovic. Hope I got that one right there for you, brother. The Butcher of Wall Street on X. I'll be posting up his links on down below. This guy has a unique insight on the markets. He's a small business owner. We've had him on the show already one time, and a perfect time to have him back as we discuss the Japan carry trade unwind. It might not be 75% done like JP Morgan suggests. We have Janet Yellen and Gary Gensler playing their role to keep things propped up and backed up, and they're doing everything they can. And we're going to show you guys a speech that just got leaked. Gary Gensler, his comments that were suggested to him don't cause panic in the markets. That's the objective these days. While they try to tell us that everything's A-OK, we head into this election cycle. We are recording this on debate day. So maybe I should start off with that question. Why don't we make it fun? And we might offend some people, but oh well. I know you don't care, Marcel. So, Marcel, who's going to win this debate today?
Who's going to win? Oh, I think that's pretty obvious here, right?
Not the American people, huh?
The American people are going to be the biggest losers here, unfortunately.
Yeah, yeah, yeah. Yeah. So, and this is something that I've been talking about too, is we want to make sure no matter who does get elected or selected, that we got a program and plan in place to get us on this greatest transfer of wealth in world history. So, Marcel, what's been top of mind for you right now? What are you focused on? What are you watching in these markets?
Right now, what we're seeing with all-time highs repeatedly being hit, and then a complete meltdown, if you will, to the fact where it's September 10th right now, and we have not had a single green day in the S&P the entire month. That's downright pathetic, but it's a sign of the times. It's continuously people keep bringing up the fact that we're seeing new all-time highs, that the market keeps ripping, and they use that as an excuse to basically make it seem as if the markets always go up. And I think you and I, and a lot of other people that are out there that are educated, really know that if you account for inflation, the reality is the market hasn't really gone up much in the last several decades. Again, the accounting for inflation, a lot of people miss that part. And that being the case, when you look at what we're currently seeing, I think it's a complete fallacy to think that markets will continue to rip upwards and rip higher, especially with the current state of the economy, the continuously revised job numbers, the increasing prices in gold, specifically because it's a less risky asset than the Ponzi fiat, and bonds increasing in value as well because it's a less risky asset than equities. So really what I'm looking at here is the financial markets as a whole and their extremely unhealthy relationship with cheap, dirty, easy government money.
Yeah, yeah. And the Japanese government or the Central Bank of Japan was giving it out the easiest, I guess, probably not proper English, but you guys get my point out there. And this takes us back to last month when the Japan carry trade did start to blow up on August 5th. They had to start hitting some of those circuit breakers. And I did see actually that you posted earlier today that Fidelity was down, of course. Every time we get a little bit of action in these markets, these exchanges go down, these platforms go down.
Hmm.
But back to the Japan carry trade, this thing started to blow up, and this happened after just a 25 basis point, a quarter of 1% rate increase from Japan. This caused everything to blow up, and many people overlooked actually the Fed came out and announced that they were going to buy back, I think some nearly 50 billion worth of bonds right after that, right? So they came in to say they were going to backstop it. We saw Bank of Japan had to intervene and they're going to have to continue to raise rates at a time when we're looking to start cutting rates. One chart that's been interesting, and I saw you talking about this earlier today, is the correlation between the S&P 500 and the Japanese yen. So, could you speak a little bit on this Japanese yen carry trade starting to unwind, where we're at with that, and what happens next to the markets?
That's a bit of a loaded question, to be honest with you, Zach. But I like it.
I didn't say it was going to be an easy one today, Marcel.
Look at it this way. If you want to pull up the chart, it's the correlation there between the Japanese yen and the S&P, basically the SPX, has always existed. It's something that's continued on for many years at this point, decades, and we're currently seeing a massive change in a giant gap, basically, right? If we're talking about charts, there's a huge gap and a variation there between the SPX and the JPY. At the current levels, to stay with the SPX, the Japanese yen needed to be around 160. You and I, we all know it's around 143 and, varying ever slightly, and it keeps wanting to collapse under 140. The government, the central bank of Japan, is consistently intervening in the Japanese yen in order to keep that above 140 with everything, with basically every fiber of their being, with billions and billions of US dollars worth, of yen worth of trade. The Japanese yen carry trade really occurred with a simple, not even a quarter percentage point. I got to correct you on that. It was already at 0.1%. So from 10 basis points, they increased it by 15 more basis points to a quarter of a percentage point. So
Okay.
in reality, the actual move itself that caused that 13% drop in the S and or not in the S&P, but that 13% drop in the Nikkei was 0.15%. And we saw a 13% drop in the Nikkei and then a 3.5% drop here in the United States. Just trillions and trillions of dollars getting wiped out. To
So
think
it took
that,
even less than what I stated. I said it was a 25 basis point. That's not the case. It was or there'd be 15 basis points that
yeah,
brought it to essentially a Bank of Japan rate of 25 basis points overall. So it took even
yeah,
less to blow it up.
it was a minuscule movement in the actual raising of rates from the Bank of Japan, but they the Japanese entities institutions have 20 trillion plus dollars invested here in the United States. They're using and abusing an arbitrage like a dirty what, whether we like it or not. And when even something so simple as the interest rates change there 0.15%, shows trillions of dollars getting wiped off the market simply because they have to hedge their bets and close their positions. It's a slight indication of a financial crisis that's inevitable. And that's why we saw what you mentioned earlier with Gary Gensler stating in his notes that were released. They were leaked. They should never have been leaked. In which there was a sentence there that said, "Insert sentence here regarding so and so that you don't give off the information regarding a imminent financial crisis." It's just par for the course nowadays, where Gary Gensler, as the right hand man to Janet Yellen on the plunge protection team to prop up our markets here in the United States, is it shows you exactly what they're doing. If you look hard enough and you actually understand the mechanics there, the Bank of Japan has their own plunge protection team, as does all these other governments, and they're literally using taxpayer dollars, your money and mine, in creating inflationary conditions, increasing our government debt simply for the justification of keeping wealthy people wealthy and poor people poor. And until they're ready, they're not going to let the stock market fall. But at some point, one of these black swans is going to come around, whether it's the Japanese yen carry trade or something else, and it's going to rock their fucking world. Pardon my French.
Yeah. Well, and markets forget they have short-term memory loss, I think, or you just have young traders that weren't around during the great financial crisis and they forget that on the same day, September 18th, which is when we get our next FOMC meeting and decision from the Fed on interest rates, when you look back, September 18th, 2007, that's when the Fed started our rate cutting cycle. And after that, the S&P 500 fell by 57% over the next year. Here we are today in 2024, and our markets are starting to cheer and rally, and they're begging Daddy Powell to give them a 50 basis point rate cut. And they believe that this rate cutting cycle is going to bring back risk on, it's going to pump it back up, and everything's going to be okay. But as you mentioned, there's some serious cracks starting to widen within our broader financial system on the back end. That's a liquidity crisis. And as I've been explaining on my channel, it's not just the Japan carry trade. That's the tip of the iceberg. When you look underneath the water, it's a global margin call. And I've even, I focus on crypto in my show a lot too, Marcel. And I've said this goes all the way from the hedge funds, taking out that Japan carry trade debt, all the way to the crypto bros that are using 100x leverage trading their crypto derivatives. It's all one great global margin call that's been fueled by the cheapest interest rates in 5,000 years. Now, the Fed rug pulled this at the fastest pace that they've ever done by raising rates so quickly. Now we're set to go into a rate cutting cycle. Japan's starting to raise rates. And so this is what's making that Japanese yen strengthen against the dollar, starting to unwind this trade, starting to spread ripple effects of a global margin call. And yet everybody thinks that there's still room for the S&P to run, that there's, still room for the markets to continue up higher, which is actually something that I looked at last month when this came out and it broke. And then after I saw the Fed come in with the backstop, I saw some of the other things that were coming about. I said, watch for them to rally this thing back up to a new all-time high, which is exactly what happened for the Dow Jones. But what's interesting is if you zoom out and you look at the Dow Jones and the S&P 500 and the Nasdaq 100, Dow Jones set a new all-time high, and the other two major indices were less than 1% away from their all-time high. Dow Jones set a triple top, and the other ones are setting double tops, and it's the same formation that's setting on all these right as we head into a rate cutting cycle that is being fueled by weak economic data that we were called crazy for being scared of, and warning of, not so much being scared, but we've been sounding the alarm. Hey, this economy isn't as strong as they've been telling us, despite what the White House press secretary's spoon feeding us. Our economy is breaking on Main Street, caused by that Federal Reserve rug pull. Now, this week, we're going to get the CPI inflation data, the CPI lie. And so the markets are actually hanging out sideways today, waiting for this to come out tomorrow. Previously, we've been seeing the markets run up into these announcements. And so is the market already getting scared, Marcel? Is that what's taking place right now?
That's tough to answer, mainly because, again, it's all a fallacy. It's a farce. The market is not pricing in the realities of the economy. And a lot of times you'll hear people say that the stock market is not the economy and the economy is not the stock market. And I have to agree with them in the sense that that's partially true, but they're both directly correlated, whether people like to admit it or not. The only reason that they're not more correlated right now is because to protect themselves against this global margin call, as you stated, which I think is a very good uh, way to put it. All of these entities in the financial sector are on the same page. The banks, the market makers, the brokers, even the DTC, they need to maintain the markets in elevated conditions in order for the fallacy to continue, the Ponzi to continue. And when you look at things like the economy, it should bring markets down. But of course, that's not happening because we're living in a Weimar Republic. This is a freaking joke of what's going on in markets, both stocks and crypto. And to say otherwise, honestly, is either one, naive, or two, uneducated in the matter. For as long as I've traded in the markets, which is 20 plus years now, uh, it's been clear that there is a ridiculous amount of manipulation happening. But what I've seen over the last 5 years, ever since what happened in 2020, everything has been exacerbated, and it's been clear that the days of the money printer seemingly being infinite are over. And guys like you and I and others aren't talking about our bad economy or our overvalued financial bubbles in all sectors for the purposes of wanting to scare anyone, more so for the purposes of educating people on the realities of what's happening. Because the average person feels it. They see it at their jobs. They see it at with their friends and family, with their homes and their apartments, their cars, you name it. Prices are up. Wages are not up anywhere nearly the same amount. Even if you change a job, a lot of people are barely able to survive. And I think a lot of people feel like, oh, this is just me, or I'm going through this, or my brother or sister or whatever's having a tough time. The reality is that this is a vast majority of America. And even who it hurts the most, honestly, is not the poorest of Americans and not the richest of Americans. It's the people in that, like that middle 80%, the middle class and the people that are not quite wealthy, but are doing very well for themselves. And the government wants to print more money to give it to other countries and to give it to the poorest people in a sort of, socialist communist way. But that's not something that's possible anymore due to the ridiculous amounts of spending that's gone on. We printed over now we the government, the United States printed over $600 billion in the last 3 months alone. The numbers just came out today. This is all obviously inflationary. They're trying to crush the middle class via higher interest rates, harder borrowings, and while at the same time reduce inflation, and they haven't even been successful at that. The only reason they've gotten inflation where it's at now is by changing the calculations and the definitions and the weight of the different items within the CPI report. So it really is a complete fallacy, and to think otherwise, I think would be uneducated. Now, I may have lost a little bit of a track of where what your initial question was, but I think the reality of the matter is that what we're seeing now, markets will continue to trade either sideways or rip slightly higher until that black swan occurs, until that glacier is revealed. Because again, I'm sure you probably have shown that Gary Gensler and Janet Yellen aren't just talking about these issues because they want to. They don't tell them to the public, but they'll say it to themselves and between their best buddies on Congress. As a matter of fact, in 2021, Janet Yellen testified in front of Congress stating that the largest threats to the global financial stability are one, shadow banks, and two, over-leveraged hedge funds. And she said that only because she was in front of a congressional hearing under oath as well. And I'm sure they figured that the majority of Americans would never find out or hear about it anyway.
Yeah. Yeah, the only thing I think that she should have included there was the folks sitting inside the halls of Congress there as well are also a pretty big threat as well. But Marcel, I want to share my screen here. This is exactly what you're talking about right here, where they're willing to speak on it themselves internally, but they weren't expecting this one to get leaked or however it came out publicly here. This is Gensler's internal comments that the SEC mistakenly posted publicly. This is how stupid they are. Now, the comment is, I strongly recommend that a sentence be placed here or somewhere in the first part of the speech to reassure markets that you are not making the speech because you think there is an imminent crisis. Okay, so is he making the speech because there is an imminent crisis? I think that we're starting to see that, right? It's being reflected in the data. The markets are scared. The AI bubble has popped. The crypto story has really popped, right? And now folks are finding, trying to find safety, right? And we didn't need Gary Gensler's internal comments to be leaked here today to be heading in that direction. We've already been going that way. But you were talking about this earlier in your live show today, and I want you to expand on this, Marcel, because folks focus on the Fed and Janet No-Tail and Yellen as far as being the one that's keeping things propped up, backstopping the Fed, turning on the money printer. But can you speak on Gary Gensler and his role? You called him the right-hand man, the little guy there weaseling around there in his little suit. Every time he makes an appearance, I always laugh because you can never get a straight answer from the guy. But he weasels in here and he loves the attention and he loves giving his speeches, but he wasn't expecting this one to get leaked here today. Can you speak more on that, though?
Yeah. In the United States, there's something that was implemented, I believe, in the late 80s called the plunge protection team. And the head of the plunge protection team is the the Treasury Secretary, Janet Yellen. The purposes of this team is to spend hundreds of billions of taxpayer dollars to prevent our markets from crashing, right? I use air quotes because there have been consistently several numbers of crashes over the years, even in spite of the plunge protection team. these people are in control most of the time. And then where they're not, then you see those global margin calls. Then you see, for example, 30 days after the biggest crash in the S&P to date in 2008, 30 days later, we saw Volkswagen go up to $1,000 a share. And this is directly related to a margin call because Porsche owned 55% of the outstanding float. Now we're seeing other equities, stocks, and crypto that are heavily owned by retail investors that are also going up in significant value that are currently being suppressed, but also have been seen to go up significantly, hundreds, if not thousands of percent in the past. And this is only by a controlled event, such as removing people's ability to buy or sell, have they been able to maintain, control of these equities. But Gary Gensler is the right hand man of Janet Yellen, and I don't just say that sparingly because she's the number one as the head of the U.S. Treasury, and the head of the Securities Exchange Commission is the number two in that field. And then right up there with them is the head of the CFTC, Rostin Beanham. A lot of people are unaware of who he is, but he's right there with them. And their job is literally to prop up the stock market. I get this a lot is like, how do they do that? How do they prop up the market? They're not going in there and spending, billions of dollars to buy stocks or to buy S&P. I mean, they can buy ETFs, they can buy, things like that, but that has a very minimal impact. They really do this by leveraging other players in the market against each other in the sense, for example, one of the most popular ways and the easiest way for them to do it is to sell naked shorts on the volatility index, right? The VIX. Most people, traders, are very familiar with the VIX, and the ETFs surrounding it, the UVXY, the VIXI, et cetera. But they don't even own, shares or options in the VIX. They're just naked shorting it in order to get high frequency trading algorithms, quants, and other funds and institutions to have to buy the SPY and other S&P holdings. And the way that that works is when they naked short the VIX, it crushes the price of the volatility index, which runs inverse to the options contracts in the SPY or in the S&P 500, if you will. So when that occurs, the market participants see that there's a massive increase going on in price there in the SPY and a massive decrease in the volatility index, and they need to hedge against that. They're basically creating an artificial gamma ramp of the SPY, which forces some entities to go out and buy the SPY. That further creates more gamma, and then other entities have to run in and do it. But this isn't something that's like manually done. It's not like some guy sitting behind a keyboard who's deciding, oh, look, the VIX is going down. Let me buy the SPY. Obviously, as you guys know, or may not know, it's all algorithmically controlled. It's all computerized. There are programs in there that are analyzing the amounts of gains and losses that these funds have at any given time and the way that it progresses. So when Gary Gensler or Janet Yellen or both decide that there's an issue going on, some sort of a black swan that's peeked its head up out of nowhere, like the JPY carry trade, let's just say that the S&P didn't just turn around on its own. These guys spent tens of billions of dollars in a single day, specifically to naked short the volatility index. And you can see that for yourself by uh, going and looking at the FTDs by the U.S. Treasury. You can literally see the failures to deliver by the U.S. Treasury, and that's on a T plus 35 cycle. So 35, you could look 35 days in the past, obviously, of course, because our markets are fair and efficient, meaning antiquated and corrupt. So you can look back and see what happened 35 days later and be like, oh, look, there's a massive jump in FTDs on that particular day. Why? Because the Treasury, right, doesn't have the sufficient shares or never bought the shares in order to buy back all of their shorts that they sold naked, right? Every short position must eventually be covered or be closed one way or the other, unless you're the United States Treasury. And then they could just fail to deliver. They hands washed, hands clean, markets are saved. Taxpayers now owe billions of dollars more, and nobody knows about it. It's as
Right.
simple as that.
Right.
They don't have to report it. They don't report it.
And I'm going to share my screen here real quick. This is that VIX index right here. And for
Yeah,
those of you
look at
guys
that
that forget,
spike.
this was insanity. We went all the way up to 65 when that Japan carry trade started to unwind on August 5th. When the markets opened up on Monday, and that's like Marcel's saying here. This is when the plunge protection team has to come in. And, it comes in a few different forms, a few different government agencies. And what it ends up doing is it's costing taxpayer money. It is a form of inflation that is not seen because it's not the Fed hitting print on the money printer, but we know how it, basically extends out to be a form of inflation. Now, because our time is limited, Marcel, we see what's happening. We see that it's breaking. Folks need to be hedged right now against this. It's been easy to be long during a participation trophy economy, good times, cheapest interest rates in humanity, essentially. Everybody was a winner. Everybody was having a good time. The game has changed. That's very clear for everybody to see. We're heading into some form of a recession, already in a jobs recession. GDP is already slowing down. And if the Fed thinks that they're going to be able to keep inflation tame as we go into a rate cutting cycle when we didn't even get close to their 2% target while they were raising rates, I don't know how they're going to land that plane, but some people still delusionally think that we're going to achieve a soft landing. But with all that being said, Marcel, as we conclude this episode, I want to get, where are you at as far as what opportunities do you see? I know that we talked about this last time, with some of the heavily shorted stocks and equity positions that you hold. Where's the opportunity? What can we do as investors to ride out this storm and then maybe find some profit if this thing does start to break?
I'm not a financial advisor. This is not financial advice, but I will say that the Federal Reserve knows that they are not going to keep inflation down. The inflation will accelerate. As they cut rates, inflation will accelerate again. We are entering a period of hyperinflation, of long-standing stagflation, which means a stagnating economy uh, while inflation is increasing, which is worse than inflation, worse than deflation, because our economy is not growing, at least not properly. It's growing artificially through the government money printing, through the government hiring 87,000 new IRS workers, et cetera. And one of the best ways to hedge against inflation is this is actual precious metals, in my opinion. Silver, gold, exactly, exactly. Keep it on his desk, smart man. Obviously, we keep more than this, right? But it's always nice to have a little bit around on display just to tell friends about it, share it on stream and stuff like that. Yeah, I remember, in 2022, we were telling people, hey, your money in the bank is not doing you any good. Consider getting silver, consider getting gold. And since then, gold has reached new all-time highs. It's up massively. Silver, at the point where I was buying this, silver was at about 17, 18 bucks an ounce, currently over 28. We saw it recently as high as 32. And in the past, we've seen it at 50.
And
And I
boy, did
wouldn't be
they have to
surprised
come
to
in
see
and
that
slow
again.
that train down when it got up to 32. We were starting to break it, weren't we?
And speaking of heavily shorted equities, these fucking precious metals are literally the most heavily shorted equities in the history of the world. The amount of derivatives that are out there simply to hold these down is incredible. Is incredible. A lot of things out there when the SLV silver ETF was running hard in 2021, Robinhood, Webull, IBKR, dozens of brokerage firms pulled retail investors' ability to buy the SLV silver ETF right along with AMC, GameStop, and other heavily shorted equities and stocks. And if you look closely at January of 2021, you'll see a lot of your favorite cryptocurrencies on there. Doge, XRP, XLM. You guys will see that there are very huge, very massive similarities there on the actual charts themselves with these stocks. And a lot of people are wondering, well, why? Why is it that, silver and AMC and GameStop and Doge and all these other, cryptos are going up or down at the same time? It's because there are baskets of securities. There are baskets of securities, that's literally what they're called, that are put into the same uh, investment or, handled in the same way by a multitude of different firms and entities. That is what caused the collapse of Archegos, dozens and dozens of other family offices and family offices and hedge funds, and as well as the collapse of the bank Credit Suisse, which is now owned by UBS. And all those legacy costs that came from all of the toxic derivatives, the swaps that were held by Credit Suisse, that were previously held by their family office that they managed, or should I say that they lent money to, our Kigos, have now become legacy costs for UBS. So UBS is now looking at all of those legacy costs associated with the failure of Credit Suisse, as well as Archegos, and that goes for dozens and dozens of other firms. Goldman Sachs is the number one lender to hedge funds, right up there with JP Morgan. They each lend to over 1,000 hedge funds each, and they are massively over leveraged in the form of derivatives. They've got a few $1 trillion worth of assets in derivatives notional value, but they've got the top four banks alone have $190 trillion worth of derivatives notional value.
But
And
but wait, Marcel, JP Morgan says we're 75% done with the Japan carry trade.
of course they do. Of course they do. And we all know that that's absolute nonsense, right? These toxic derivatives are out of control. They like to say that they use netting and bilateral netting through the continuous net settlement system in order to cancel off these contracts. But even still, if all of that were to happen, these banks would still be hundreds of billions, if not trillions of dollars in the hole at the end of the day after all of these trades were netted out, if everything were to collapse at the same time. And there's no way in hell that JP Morgan is ever telling us peasants the friggin' truth.
You mean Jamie Dimon, the same guy that said, "Hey, Bitcoin's nothing but a pet rock. We ain't gonna do nothing with it. It's just for criminals." And then once they get ready, then they're set up to be custodians for the ETFs, and they start to delve in. Once they're ready to sell the product, then it's time to get bullish. And now you got the CEO of Van Eck coming out and saying that Bitcoin's going to go to like 3 million, or the bullish case by 2050 is a billion. But I mean, it's just ridiculous, right? It's like these guys are pumping Bitcoin harder than the Bitcoin bros are. It's like, what just happened here? But they're ready to make their money now. Now, this is what's been interesting. I've been watching your project since we first spoke. Speaking of exchanges, right? I've been watching your product and how you're kind of working to bring about more of a level playing field when it comes to participating in these markets. So I'm going to have all your links up down below in the description of this video, but folks can take a look here. I'm going to share my screen real quick and show folks this is going to be your new platform, Lit Exchange, which is a real
Yeah.
exchange that you are creating, the world's first fintech company developing stock and crypto brokerage for retail investors by retail investors. And you're given the opportunity for folks to invest and become founders of this project themselves. So, just a couple words on that, Marcel, and everything will be linked up down below.
Yeah, aside from silver and gold, I think private equity is a really good opportunity for a lot of people. Naturally, being private equity, it carries risks. But here we are literally giving retail investors the opportunity to own a upcoming stock and crypto brokerage firm. That's the whole purpose, is to stay away from hedge funds and try to get retail investors to be the owners of the company. Aside from a bunch of other perks and benefits that are listed there on the FINRA approved funding portal, which people will see, in the links below, as well as, along with the offering memorandum, the business plan, and everything is going to be all there to explain it to people because there's not enough time to do that. But long story short, private equity has a lot of potential if you're able to invest in it, and this isn't some Kickstarter that we're not asking for donations. This is an investment through a FINRA approved funding portal that when we IPO, people will then have the opportunity to sell their shares for what we believe to be a significant profit. Although I cannot speculate on how much that will be. Legally, I cannot speculate on it. Let's put it that way. But there are plenty of speculations there in the offering memorandum as well, laying out all the risks and everything else associated with it. But there's huge potential there, and we're giving retail the opportunity to buy equity ownership in the company.
Yeah.
The whole purposes are to avoid dark pools and payment for order flow from the price distorting dark pools, because that is the number one way that market makers, hedge funds, and broker dealers are literally screwing retail investors every single day. These brokerages are pulling the buy button, making it impossible to log in, withholding your crypto, and all sorts of other things that are screwing retail. And a lot of people are still, using their platforms. Why? Because there's no alternative. So this is the retail's chance to have their own alternative in which they own the damn company instead of Sequoia or State Street or Jane Street.
Yeah, yeah, that's awesome. Well, Folks, it's not an endorsement for me. You're going to have to do your own research, but I will say that I commend the effort because this is what we need to bring to the people. This is what got me interested in crypto. This is why I like the XRP ledgers because it's a decentralized exchange built into the ledger. And I think that it's just a matter of opening up these platforms for the people. We talked about this before we started the call, Marcel. If Gary Gensler had his way, he would take accreditation standards to 10 million. He would make it so that even less people get access to these opportunities. And it's very unfortunate.
Why should
Meanwhile,
rich
he
people
likes to
be the
tout that
only
we got
ones,
the
right?
gold standard of capital markets. And if he continues with his program, I think we're going to be the gold standard of fraud and corruption. But with that being said, Marcel, it's been a pleasure. I wish that we had more time here today. So we'll have you back here soon. We're going to be following your story. All the links will be down below. And it's been an absolute pleasure having you. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.